Thanks, ma'am. Good evening, ladies and gentlemen, and thank you for joining us for a discussion on RBL Bank's financial results for the second quarter financial year 2024. I'm as always, joined on this call by Mr. Rajiv Ahuja, Jaideep Iyer, and our CFO, and other members of our management team, who along with me will address any questions that you have. I'm happy to report that this quarter has been a continuation of our path of improving the financial performance, and as a result, we are on track to build a predictable and stable balance sheet. We continue to track well to our guidance on return ratios, asset quality, credit cost, and operating performance. We continue to see good growth opportunities in our chosen segments, broadly helped by largely moderate risk environment, enabling us to pursue a calibrated growth path and generate an improving financial outcome. That said, we have taken some steps to proactively create buffers, which we will speak on shortly. Now, before we get into the operating performance details, I want to briefly discuss the changes, improvements made in this quarter and the positive impact on balance sheet. You would have seen the details in our investor presentation, starting slide number 5. We have taken these steps to strengthen the balance sheet and provide a transparent, a comparable data of all business segments, which is a better reflection of our operating business model in our financial disclosures. I will take a few minutes to explain the same. Firstly, you will recall that we have in the past spoken of creating a contingent provision in our credit card and microfinance business segment over next year or two. Our bank has significant portfolio in credit cards and microfinance, which together account for approximately 35% of the total advances of the bank. These two business segments also contribute significantly to the profitability of the bank. In years past, both these businesses have been elevated levels of stress due to external events, which has resulted in higher slippages and consequently higher than average cycle credit cost. In this quarter, the bank saw a write-back of tax provision of earlier years of 223 crore, which is a direct PAT benefit of 223 crores, and hence a benefit of 298 crore pre-tax. Rather than show this write-back as a one-time increase in PAT, we have prudently decided to use this for creating a contingent provision of 1% base level amounting to 252 crores on both the credit card and microfinance portfolio. Going forward as well, as an ongoing practice, we will continue to maintain 1% on the incremental book of credit cards and microfinance. We believe that this is a good first step in building buffers in our balance sheet for these two key businesses. We will look to increase the contingent provisioning further in the future. This provision also will help us in significantly minimizing impact on ECL on this portfolio as and when banks transition to the ECL framework. For the sake of clarity, I would want to reiterate that we are doing this as a prudent measure and not because of any underlying asset quality issue that we are anticipating. Secondly, in our credit card segment, as a policy, we provide 70% at 90 plus and provide fully at 180 days. We are now modifying our provisioning policy to provide 70% at 90 plus, as was earlier, and now provide fully at 120 days. The impact of this change was 48 crores. This again is a step to be more prudent in our higher credit card segments. higher credit cost segments. So in summary, we had a write-back of tax provision of 298 crores, of which 252 crores was used to create a contingency provision, and rupees 48 crores was the impact of the policy change in the credit cards. You will see the details of this in slides 10 and 23 in our investor presentation, and we can address any questions on these changes in the Q&A. And lastly, starting this quarter, the bank has reclassed the charges paid to our business correspondents. The business correspondents are largely used in our microfinance business, with the largest being our 100% subsidiary, RBL Finserv Limited. Historically, the bank used to net BC charges against the interest income line, with the reason that the BCs are paid from the interest income earned on the portfolio. In this quarter, we have taken the decision to reclass this to the expense line for improved and comparable presentation. As a result, we are moving charges paid to BCs to the operating expenses line, and consequently, interest income and operating expenses increase to the same extent. There is no change in operating profit, PBT, PAT, ROA, ROE because of this reclass. However, both NII and OPEX increased by the same amount. I just repeat, there is no change in the operating profit, PBT, PAT, ROA, ROE because of this reclass. Only NII and OPEX increased by the same amount. We have done this change for two reasons. Number one, better presentation of the financials, as this gives a clearer picture on what is earned across the book. And two, this is in line with the industry practice. For full transparency and change, we have also shared the financials of the last 6 quarters, both before and after this reclass, on slide 6 to 9, both on the standalone and the consolidated level. Now on to our business performance for the quarter. Firstly, on growth. I'm happy to report that we have grown our advances in Q2 at 21% YOY and 4% sequentially, in line with our growth guidance. As per our business plan, retail advances have again grown at a faster pace with a growth of 35% YOY and 8% sequentially. Wholesale advances grew 7% YOY. Within wholesale, commercial banking has grown 17% YOY and 11% sequentially. We have been able to improve the momentum in the retail businesses and the retail disbursals. Our disbursals across all our retail businesses, other than the card, was approximately 4,300 crore this quarter, as compared to 4,100 crore the previous quarter and 2,500 crore in the same quarter last year. Microfinance disbursals were at 1,985 crore this quarter. Housing saw a disbursal of approximately 800 plus crore. And the tractors, which we call it as a RVF, of 270 crore in the last quarter. LAP, loan against property, has picked up well and saw disbursals of approximately 700 plus crore this quarter, in this quarter which Q2. These products are growing at a higher rate than the existing retail products, albeit of a smaller base. In cards, we saw an issuance of 5.9 lakh this quarter. In a nutshell, we continue to see broad-based retail growth this quarter as well. Our retail asset book has exhibited a strong growth of approximately 35% over the last few quarters, and we expect to maintain a 5 to 8% sequential growth each quarter. Our newer retail businesses will grow at a faster rate of a lower base. We have seen a 190% YOY growth in the disbursement in our home and secured business loan book, and have done significantly better in terms of yields on these businesses. The branches and the direct sales today account for almost 20% of our disbursals, and we would want to take this close to 50% been an important focus area as it has 1. Reduce the cost of acquisition, 2. Improve the engagement with our liability base, and 3. Aiding new liability customer acquisition. All these parameters show that there is improving momentum at the ground level to drive cross-sell, and we are increasingly confident of upping this pace. We have started generating leads in our microfinance segment for tractor loans and hope to start the pilot of lead generation for small business loan and housing loans from this segment by Q4. We are looking over a time to leverage the 1,200 BC points that we have in addition to 500 plus branches. We are also in the final stages of launching a digital savings account for our valued credit card customers, and we have already launched a digital term deposit account which will be used to onboard a broad section of customers from credit card, microfinance and retail products. On rural vehicle finance, we today have an approximately 4 to 5% of the market share in the areas where we operate, and we continue to expand to the newer states. We expect to do better in RVF disbursals in H2 of the current financial year. This segment is growing 100% plus YOY of a low base. On other vehicles business, we have started disbursals for two-wheeler and used car loans, and these will start seeing meaningful traction in Q4. On deposits, we saw a 13% YOY growth in overall deposits and a 5% sequential growth. We, however, as planned, saw a 23% growth YOY and 8% sequentially in deposits below rupees 2 crore, which now forms 43.9% of the total deposits. Our expectation is to increase this proportion in the coming quarters as we aim to get this closer to 50% in the coming quarters. This is led by increased product penetration amongst new and the existing loan customers by cross-selling of liability accounts in addition to new customer acquiring. The process of tapping the existing asset customers for their savings, current accounts has already picked up pace with specific targets allotted to the branch and asset teams. Growing granular deposits continue to be the key focus for the bank, with the objective of having a diversified liability franchise and also have a large number of customers to whom we can offer a multitude of asset products, which we now have. This also allows the bank to grow the customer franchise as the bank is now enabled on multiple asset products to fulfill the customer's borrowing needs. CASA deposit grew 12% YOY and 1% sequentially. CASA ratio was at 35.7%. On asset quality, we have further improved on all asset quality parameters. Our GNPA and NNPA are lower QOQ at 3.12% and 0.78% respectively versus 3.22% and 1.00% respectively last quarter end. Our provisioning coverage ratio is also up sequentially at 75.6% versus 69.6% last quarter. We had a total slippage of 541 crore this quarter as against 555 crore last quarter. Recoveries and upgrades was 166 crore. Our net slippages were therefore at 375 crore as against 289 crore last quarter. We also had a total recovery of 144 crores from written-off accounts. Of the slippages, 15 crore pertained to the slippages from wholesale and the recoveries of 8 crore, so that the net slippages in the wholesale was 7 crore only. In microfinance, our slippages were 60 crores, recoveries and upgrades were 16 crore, and our net slippages were at 44 crores. In cards, we had a slippage of 334 crores and the recoveries and upgrades of 43 crores, with the net slippages being at 291 crore. Our gross slippages in other retail was 131 crore. However, net slippages in retail were 33 crores, because of upgrades and recoveries. Our net restructured advances stood at 0.89%, down from 1.05% in Q1 FY24. Provisions. We took a total provision on advances, which is NPA, restructured, contingent and standard asset provisioning of 766 crores in this quarter. The split up. Of this provision on NPA was 464 crores. The contingent provision on credit cards and microfinance was 252 crores and 48 crores was towards credit card provisioning as per the change in our provisioning policy, which I just spoke earlier. That is, providing 100% at 120 DPD as against 180 DPD. There was a release of 14 crore on restructured advances. The standard asset provision taken during the current quarter was 16 crore. We had recoveries from written-off accounts of totaling 144 crore. Net provision on advances, therefore, was at 622 crores as against 260 crores in the last quarter. The credit costs for the quarter were 47 bips as compared to 39 bips in the last quarter on a like-for-like basis. The contingent provision and the additional provisioning in cards owing to change in the policy adds another 43 bips to quarter's credit cost. So in total, the credit cost was 90 bips. We continue to remain confident of maintaining our credit cost guidance of between 1.5% to 2% this fiscal. On profitability, Q2 saw a sustenance of improving the financial performance resulting in our profit after tax at a consolidated level, including our subsidiary, increasing 77% YOY and 4% sequentially to 331 crore. The bank on a standalone basis saw a PAT increasing 46% YOY and 2% sequentially to 294 crore from 288 crore last quarter. ROAs were 1% this quarter, up 23 bips from the same quarter last year. We continue to work towards improving this performance in the coming quarters. Our NII was up 22% YOY and 5% sequentially at 1,302 crore before the reclass and 26% up YOY and 4% sequentially at 1,475 crores post the reclass. Other income was 704 crores this quarter, higher by 21% YOY and 3% sequentially. Core fee income grew 25% YOY to 678 crore. Our total income was up 22% YOY and 4% sequentially at 2,006 crore before reclass and up 24% YOY and 3% sequentially at 2,179 crore post the reclass. Our NIMs this quarter was up 35 bips YOY and 5 bips sequentially at 4.89% before the reclass and 53 bips YOY and 2 bips sequentially at 5.54% post the reclass. Our OPEX was up 12% YOY and down 1% sequentially at 1,276 crore before the reclass and up 16% and down 1% sequentially at 1,448 crore post the reclass. Our cost-to-income ratio was 63.6% this quarter against 66.5% in Q1 FY24 before the reclass, and the same stood at 66.5% as against 69.3% in Q1 FY24 post the reclass. So effectively, we have seen a decrease of 300 bips in cost-to-income ratio sequentially. While we have been able to maintain our cost base to almost the same level as the previous quarter, we expect to see some lead lag in terms of cost and corresponding income increases given the expected higher business volumes in the second half of current financial year. We saw a healthy increase in PPOP this quarter at 731 crore, up 43% YOY and 13% sequentially. no impact because of reclass. Consequently, profit after tax was 294 crore for the quarter, which is 46% higher YOY and 2% higher sequentially. Lastly, on capital. Our total capital was 17.07% and our CET1 ratio was 15.15% as at September end, as against 16.68% and 15.05% at the last quarter end. In summary, we continue to see steady and improving profitability and remain on track for ROA guidance for this year. We are confident that our profitability guidance will be achieved for the full year. We should see a steady growth in advances in the range of 20%, with the retail leading the way. At the same time, the granular deposit growth will be significantly higher than the 18 to 20% deposit as we aim to get closer to 50% share of the small ticket deposits in the coming quarters. Our execution focus remains on scaling up the new retail asset products, and we are very excited with the opportunity that we see. Rural vehicle finance is a great example of us having achieved a 4 to 5% market share in the geographies where we operate in less than 2 years' time, and the microfinance clocking 2% market share. As mentioned in earlier calls, we see a huge opportunity to cross-sell given our large customer base across liabilities, cards, and MFI. Several new products like home loan, auto loan, two-wheeler loans, business loans, MSME, and gold loans are a natural fit for our large customer base. Lastly, we continue to see a stability in the management team. With the progress we have made in the last year or so, the morale, the excitement that I can see in the 20,000 plus team gives me immense satisfaction and confidence on the way forward. With this, we will open the session for question and answer. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi. So, firstly, just wanted to get the sense that despite the
I'm sorry to interrupt, sir. Your audio is not clear. We would request you to use your handset, please.
Yeah, I'm using the handset only. Is it clear now?
Sir, please continue.
Yeah. So I was just saying that despite creating this 1% contingency buffer, we are still at almost like we are continuing with the credit cost guidance. So would we have missed it if this buffer was not created?
Can you repeat that, Kunal? The question? Yeah. Can you repeat that? 1% of contingent provision. What is the next part of the question?
No, I'm just saying that if we had not created this contingency buffer, have we missed out this credit cost guidance?
Credit cost guidance remains at 1.5 to 2, what we said earlier. It remains, whether with or without, whatever it is. It is going to be the same.
No. The 1.5 to 2% credit cost guidance that we have given excludes the contingent buffer that we have done this time.
No. So the only thing was that given that we have already created the buffer now on credit card, on MFI, the comfort on managing the credit cost should have been relatively better, and at least we would have seen some downward revision in the guidance as well. And suppose if this was not created, then ideally would the credit cost could have been better over higher over next 2 years?
This contingency was created on the standard assets, and we are maintaining the credit cards at the same level. If you see that, it was 39 and it is 47 bps is what we have seen in this quarter. And we will be able to maintain the same level of collection efficiency and underwriting efficiency, and we will not slip much beyond than what we have been projecting it.
Just to clarify, this 1% contingency buffer is not expected to be utilized for our normal credit cost.
Okay, perfect. Yeah, so just wanted to get that. So this is not going to be utilized at all, and we will keep on building up this buffer.
Yes.
Okay. And secondly, in terms of this entire reclassification, so if we look at the quantum and just see as a proportion of disbursements, this seems to be quite on the higher side when we look at the classification. So not able to gauge in terms of how we should overall look at the BC cost vis-a-vis either the loan book or the overall disbursements, because if we assume like say 4,300 odd crores of disbursements and the BC cost which is getting adjusted for last several quarters, the quantum is quite high. And the second question is how much of this goes to the subsidiary and how much this is outside of the subsidiary.
So, Kunal, first of all, this is not to be compared with the entire 4,000 crores of retail deposit, the retail disbursements that we have written. This is substantially related to the microfinance business. And 90% or so of our business in microfinance is originated through the subsidiary.
Yeah, no, so the way to look at it is if it's like say 2,000 crores of MFI disbursements, okay, and 90% of that maybe on 1,800 odd crores. And if we look at the...
Yeah, no, Kunal, just a second, sorry. While it is actually not dependent on disbursement, it depends on the AUM. Because the subsidiary also manages services, collects, so it's not an origination fee, it is a payout based on the underlying AUM.
Okay. So if we have to look at it, so broadly maybe doesn't it seem to be relatively on the higher side, even if we compare on a maybe even on a AUM basis, that still seems to be quite high. Like say if I assume like overall AUM to be 6,800 odd crores, this is almost on a quarterly run rate 2.2 odd % of the AUM.
Correct. It will be in the 7.5 to 8% range. You're absolutely right.
Okay, so it will be somewhere around 8% annualized kind of a number.
Correct.
Okay, and this entirely...
That is roughly the standard industry payout for microfinance BCs across most other banks. Give or take 0.5% here and there.
Okay. And this goes to the subsidiary entirely because there doesn't seem to be much change in the reclassification when we look at the consolidated earnings. That's hardly like 20 odd crores in consolidated. Differential in terms of interest income, but major is coming through the subsidiaries only.
Correct. Absolutely.
Okay. So it's only pertaining to MFI, nothing beyond that. No other product segment beyond that.
Correct.
Okay. Thanks a lot for the clarification and all the best. Yeah.
Thank you.
Thank you. The next question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening. I have two questions. So firstly on the OPEX, if you look at the operating costs, they have been declining over the last 2 quarters and the growth is at about 12% year on year. So, could we expect that OPEX will grow at a run rate lower than the rest of the business growth?
I think we would be comfortable in saying that on a medium-term basis, not on a every single quarter basis.
Okay. And, so any guidance on the cost-to-income ratio or the cost-to-assets ratio?
See, we said at the beginning of the year that cost-to-income ratio, we will be making an attempt to reduce it by 2 to 3%, right, over what it was in the earlier. Now, already we have just come nearly 300 bps, we have reduced it. Going forward, we will reduce by another 1 or 1.5% than what it is.
Generally, you should see a lower cost-to-income rate.
Got it. And secondly, on the cost of funds, so when do you expect it to peak and just some color on the peak cost of deposits that you see for yourself?
So, ceteris paribus, we are pretty much close to having done the repricing, maybe another few basis points left. But we will, given the asset mix change and the way repricing is happening on the asset side, we would expect margins to marginally inch up from here further. We already have added around 5 to 6 basis points this quarter. We had also guided that margins were bottomed out last quarter, and I think we should continue to improve from here on further.
Sure, got it. That's all from my side. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Sandeep Joshi from Unifi Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So my question is just continuation to Kunal's question on the BC cost we pay to the subsidiaries. So sir, I see that our RBL business is already earning PAT of about 30-35 crores on a quarterly basis, and I assume this trajectory is going to continue. So since the subsidiary doesn't require capital, are they planning to revisit the BC charges which are being paid to the subsidiary?
We'll take a call on that in general. I don't think there is any specific plan right now. But yeah, I mean, because it's a 100% subsidiary, it's not a big deal either way.
Okay. And how do we flow back the profits over here?
So RFL has gone through a little bit of a pain 2 years back because of COVID. So, ultimately when the profits are good, the only way to claw back would be through dividends.
Oh, okay, understood. And so just a hypothetical question over here. So we are giving some guidance on ROA improvement. Okay, so while giving this guidance, are we budgeting any change in the BC charges we pay to the subsidiary?
I don't think that's going to be a material impact either way.
Oh, okay, got it. Thanks.
Thank you. The next question is from the line of Subhranshu Mishra from PhillipCapital. Please go ahead. Mr. Mishra, I have unmuted your line. Kindly proceed with your question. As the current participant is not answering, we'll move on to the next question, which is from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Good afternoon, everybody. And congratulations, sir, on a very good set of numbers. Sir, I have just a couple of questions. In our guidance, we have talked about retail mix to be in the range of 60 to 65%, right? And already we have seen a good improvement in the first half, where the retail mix has gone up to around nearly 58%. So are we revisiting that guidance? How do we see that?
See, we are on track as far as the guidance is concerned today, around 60 to 60%. And we feel that at this moment of time, we will continue to maintain our 60 to 60% guidance. And we are confident of achieving it. Maybe we will revisit after the 2 quarters.
Yeah, see, also, just to add, just to add, I think within wholesale, you will see that commercial banking has grown quite materially. So that's a pivot in that business that's happening where we want to grow more commercial, more mid-market, given the pricing structures and the opportunity that a bank like us has. And as that pivot matures, we would again, possibly see that the wholesale growth overall that we are seeing today can come back. So we can't be very precise about this.
Thanks a lot. I was just wondering that if there is an upward bias to that number, given that we have 2.5 years to reach to FY23. That is the reason I wanted to understand. Okay. Second, on this reclassification of BC charges, I think most of the points are cleared. I just wanted to understand on consolidated basis, if I see the numbers, it's not a very material impact. Is that understanding right?
So the subsidiary made approximately 30 crores of PAT this quarter. So you can judge materiality on that basis.
Okay, fair enough. Thanks a lot. That's all from my side. And best of luck.
Thank you.
Thank you. The next question is from the line of Saurabh from JP Morgan. Please go ahead.
So just 2 questions. One is, what do you think will be your normalized LCR? A stable state of operations. The second is essentially on this credit card slide that you have disclosed, fair to say that at least in the industry there is some level of increase in early delinquency?
LCR should be in the 120 to 125 range. Sometimes we do go up depending on liquidities and flows, but that should be the normalized range. Vikram, you want to take the question on industry delinquency vis-a-vis us?
We have a slide in an investor presentation which, though comparison is, about a quarter back, the industry comparison vis-a-vis us comes with a little bit of a lag. But there is nothing which is out of pattern or alarming or reason to point out as of now.
Okay, I was just looking at this 30-day plus which you have disclosed, and that seems to be showing an increase. But you think that is seasonal or?
Yeah, I think you can't conclude because this is data as of June. You can't conclude on 1 or 2 months of trend.
Okay. Got it, sir. And just one last question, sir. On this deposit piece again, how much of your total deposit will be branch banking there?
So I think the better metric, honestly, is that we disclose that below 2 crore deposits is now running at about 43-44% for us, which is the granular deposits. Branch contribution actually will be higher because branches also do, businesses which are in the 2 to 10 crore range. So that should be closer to 50-55%.
So the total will be 85 to 90% branch contribution.
No. I'm saying including this. So total will be in that 55-60.
Range of 55-60.
55. Okay, got it. Thanks.
Thank you. The next question is from the line of Abhishek M from HSBC. Please go ahead.
Hi, sir. Good afternoon, and thanks for taking my question. So my first question is on this slide on the credit cards, again, slide 35. In which cohorts is the industry relatively worse off compared to you? So where is the stress higher in the industry and you've been doing a better job of maybe customer selection and servicing? If you can shed some light on that.
Vikram, you can respond.
So see, cohort-wise comparison is not here in the slide or we have compared, but this is aggregated subsection of the cohorts and in which we are range bound and doing slightly better than the industry. I think the answer is that the comparison at a cohort level we haven't done with the industry, so we would not be able to exactly say that which cohort for industry is worse off than us.
But Abhishek, in general, we have seen the extremely lower end of limits/ticket sizes being slightly higher stress than a general.
Yeah, I mean the general guidance on what we have gathered from the industry is that low limit PLs and low limit cards have been causing stress. We largely do not operate in that space. When I was saying what I understood out of cohort was the origination vintage and not the credit limit vintage.
No, so I understand that. Maybe you've definitely been doing a better job of customer selection. My question is more on, okay, let me put it this way. Are you seeing more stress in the industry in, let's say, self-employed or in a certain like tier 3 cities, tier 2 cities? What segment of the industry are you seeing more stress in? And over the last, let's say, 6 months, is it a more generalized stress across the book for the industry, or there are any specific cuts where you see this stress going up?
So as Jaideep has pointed out, large stress which has been seen in last
only the lower ticket
quarters, are largely neither in the town tier category or customer profession category. They were largely into those fringe low limit loans and low limit cards which have been given. So the players who have expanded in the fringe credit segments have seen stress. Otherwise, the core prime market is holding on credit performance.
Okay. I just thought that would not have led to the whole industry worm going up that much if it's all in the fringes. But anyway, it's okay. I'll take it offline. Just one very quick question on MFI as well. So there your disbursements in the last 3 quarters have been coming off, where industry delinquency trends are all better. QOQ, if I look at your last three updates, presentations. So why are we slowing down there?
See, as far as MFI is concerned, it is not the slowing down. If you have seen that we are in the range of around 2,000 crores per quarter, and the only quarter where there is a difference is that in respect of the Q4. Normally the Q4 is a little higher one. This 2,100, 2,000 is a conscious because the number of branches where we just keep moving up and down. So the trend is not going down. It will be catch up with what we have been doing. So this is the general one. Maybe it's 200, 300. Only differentiation was the Q4. Don't take Q4 as a benchmark. Take other 2,000 as a average numbers in which we'll operate.
Got it. Thank you, sir. Thank you. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Anand Dama from Emkay Global. Please go ahead.
Hello. Thank you for the opportunity and great set of results, sir. So first, you have talked about the ROA guidance of 1.4, 1.5% by FY26. Can you just walk us through how you basically plan to achieve that kind of an ROA from about 1% that we are clocking right?
Anand, I would request you to get into that presentation our second line team made and retail deep dive. There is a special one where we have just segment wise, we have just said that how we would reach that 1.3 and 1.4 by 26, and thereafter I will take off. That's a very longer one. I request you to get into that and then get observed. Otherwise, we can take a little more details.
Yeah, I think summary-wise, while it's a long answer, but in summary, what we are saying is that we are investing today in our liability franchise and our new product franchise on retail assets, which are today consuming capital. As they get to scale, they will start reducing losses, and that is how the delta will happen.
So basically, you also expect the margins to expand from current levels, or you believe that the margins are likely?
Yeah, okay. Yeah, on a DuPont basis, yes, on a DuPont basis, we will see expansion in margins, steady steady fee to assets, marginal reduction in cost to assets, and the marginal increase in provisioning to assets. So the delta will come primarily from margins and a little bit on costs.
And for margins, you believe it's going to be mainly by managing the cost of funds, right? Because I think in terms of yields, you're already high in terms of the unsecured loans.
No, I guess we are also getting into products which are giving us yields in the 10 to 16, 10 to 14 range. So those will be additive to margins, even though they are secured loans. So it will be a combination of mix of advances and some ceteris paribus, some cost of funds reduction.
Okay. And I believe the RBI, AFS audit would have started for this year, and believe some preliminary report would have come. So on two counts, is there any observation from RBI in terms of the recognition of provisioning policy for the bank? And secondly, we also have this RBI nominee on the board, who is retiring on December 16th. So any communication on that front, anything that basically you can talk about?
The nominee director has been appointed as a fixed term. We know the term where it stops. As regarding the audit, it is a continuous process. There will be an audit every year, and the people will be working on that. There's nothing special about it, and this is something which is a continuous process.
Having said that, Kunal, given the way we manage, I don't think we are expecting not only this inspection, last inspection, the inspection before that, and the next 10 inspection that we will have a provisioning divergence.
Because I was just wondering that, this provisioning that we have started making in the contingent buffer is a very good step. But the timing is primarily because of the noise that we are hearing on the unsecured loans front, or what was the reason basically?
No, Kunal, the timing is because of the tax bonanza that we got.
Yes.
Timing is because of the tax.
So one time.
See, we've always wanted to do this. It's always difficult to start because we can manage the flow, but it is difficult to create the provision on the large stock, right? So when we got an opportunity, we have taken it. It's got nothing to do with any kind of stress in the book.
And any target like this 1% should go to 4 to 5%, because there are like a lot of microfinance players have talked about making 5% provisions on the MFI book. So anything on that front in terms of target that where you want to take it?
First, you appreciate the point that this we wanted to start it from Q4 over a period of 1 or 2 years, which we just upfronted it because of this amount. Whenever there is such a windfall comes, we will tell you about whether it can go up to 1% or 2%. Today, we have finalized at 1%. Incrementally, 1% will continue quarter on quarter.
Sure, sir. That's great.
On incremental growth.
Sure, sir. Thanks, sir.
Thank you. A reminder to all the participants, anyone who wishes to ask questions may please press star and 1 on their touchtone telephone. We'll take the next question from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi, good evening, sir, and thanks for the opportunity. Sir, on your margins, right, so this quarter, if we see, there is a very favorable loan mix. Within wholesale, we have grown commercial, and there is almost a negligible growth in the large corporate. Within retail, we have grown, the high-yielding book, credit card and MFI, and still, the margin expansion on whichever basis is only 3 to 5 basis points. So how do you see that progression, even if, such favorable loan mix may not reoccur?
See, if you look at our plan of action for the growth, we always said that we will be growing the commercial in the range of around 15 to 17% on an ongoing basis. So that is going to continue. The second, we also said that we will be doing the mid-range product of the retail, which is giving an average yield, as you have been telling it earlier, around 14% will continue to grow. If you look at the growth for this quarter, our credit card grew by 27% and our MFI grew by 78%. It may not grow at the same rate in future because the base is increasing from 4,000 to AUM of 8,000. So it will grow around 25% on average. And in between the other multiple products which we launch, which will give an average mid-yield of around 14%, will grow by 30 to 35%. We have already said that the new products will grow at least 30% contribution by the end of the year. So we are confident that the current margin can be maintained with this particular one. And it will always inch forward because as far as the cost is concerned, as most of them as pre-pricing has taken place, there may be a very small addition to that in the next 2 quarters. So we are confident that it's not only maintaining it, to move up by a couple of bits.
Yeah, and Jay, just to add, I think, the increase in margin is coming on the back of a 14 basis points increase in cost of deposits and 18 bits increase in cost of funds, which is a function of where the interest rates are and how the repricing happens on deposits.
Right. So in the same way, sir, the deposit growth is slightly much lower than the 20% that we envisage. So as you ramp up the deposit growth, which will be necessitated as you continue to grow your asset mix, do you see a case for, a pressure on the cost of deposit also? Because for mobilizing these deposits, you may have to, you may not be able to lower the card rates, etc. So do you see that for us, which is a growing bank, do you see more pressure on cost of deposit, even if the systemic deposit may not be may start to cool off?
So there, we've actually already said that, a large part of the repricing is done, and I think there's only a tail left in terms of what we're seeing. Also, given our distribution franchise across wholesale and branches and the kind of growth we are seeing in retail deposits, I think for us to get 18 to 20% deposit growth, it doesn't look likely that we need to be doing something different from what our peers are doing. So yes, I think I would say that, because we have calibrated our advances growth in that 20% range, 20 to 22, it is well within our distribution franchise on the liabilities between branch and wholesale to be able to get to that run rate quite comfortably.
Sure. And lastly, on the OPEX, right? So, in your, March, when we had unveiled FY26 vision, I thought that the OPEX cost would be slightly front-loaded in the initial quarters as you would start investing in the processes, product, etc. But so far in the last 2 quarters, the OPEX growth has been actually much muted. Any thoughts around there? on the OpEx? I mean, why is it low? Why is it on the lower side? And you had mentioned that it may not be, ideally it can go up, but any thoughts there?
See, the current, whatever that particular scale you are seeing in the retail, all the investments have taken place much before what you are told. This is printed in the last 2 quarters of the last year. That is H2 of last year and H1 of the last year. Predominantly saw all our investments in technology and branches and other things. Going forward, that's why I said we are going to invest in more branches. Maybe around another 50 branches will be opened. And the line which we are expanding from the current states, wherever we have, and we are expanding a geography for our loan, there will be a further investment. That's why we said that there will be a little extra investment in H2. Suppose we expand. See, we have invested in certain capacity. Once the capacity is utilized, we'll start investing in expanding the capacity parallelly. Now, today you are not seeing much because of that investment is being leveraged now. So once that leverage reaches a certain threshold, then the first investment will happen. And now also the investment is parallelly happening in respect of expanding our branches as well as the manpower and the resources. So it will be gradually increasing.
Understood, sir. Yeah, that is all from my side, sir. Thank you and all the best.
Thank you. Ladies and gentlemen, we now conclude the Q&A session. If you have any further questions, please contact RBL Bank Limited via email at ir@rblbank.com. The email ID is ir@rblbank.com. On behalf of RBL Bank Limited, we thank you for joining us. You may